You have $100 and you have no idea what to do with it. Most people would just spend it on something they don't even need. But the smart ones, they put it to work. Because here's the truth nobody tells you. $100 invested today could be worth $3,000 30 years from now. That's not magic. That's just math. And in the next few minutes, I'm going to show you exactly how to do it, step by step. No complicated stuff. No finance degree needed. So stay with me, because by the end of this video, you'll know exactly what to do with your first $100. First, let's kill a myth that stops a lot of people before they even start. Most people think you need thousands of dollars to begin investing. You don't. Thanks to modern apps and something called fractional shares, you can start with as little as $1. So $100 is actually a perfect starting point. Not because it's going to make you rich overnight, but because it builds the habit. And in investing, the habit is everything. But before you put a single dollar into anything, you need to do a quick check on yourself. Ask 3 simple questions. First, do you have any high interest debt, like credit card debt? If yes, pay that off first. No investment will reliably beat 20% interest. You'd be losing money trying to invest while that debt grows. Second, do you have even a small emergency fund? Just $300 to $500 set aside for unexpected expenses. Because if something goes wrong and you're forced to pull your investment out early, you could lose money. And third is this $100 money you won't need for at least a year. Investing is not for money you'll need next month. If you answered yes to all 3, you're ready. Let's move on. Now you need a place to actually put your money. You have 3 solid options. The first is a regular brokerage account. You can open one on platforms like Fidelity or Charles Schwab. There are no special rules, no age restrictions on withdrawals. You just invest and watch it grow. The second option is a Roth IRA. This is a retirement account with a serious superpower. Your money grows completely tax-free inside it. That means when you retire and start taking money out, you pay 0 tax on all those gains. 0. If you have earned income and you're under 50, this is honestly one of the smartest accounts you can open. The third option is an investment app. Platforms like Robinhood or Public let you get started in just a few minutes right from your phone. For most beginners, a Roth IRA or a beginner-friendly app is the move. Pick one and open it today. Don't overthink it. Okay, so your account is open. Now, what do you actually buy with your $100? This is where most beginners freeze up and start overthinking everything. So let's make it simple. Don't pick individual stocks. Not yet. If you put all your money into one company and that company has a bad year, your money takes the hit. Instead, buy something called an index fund or an ETF. Think of it like a basket. One basket holds hundreds of companies at once. So if one company in that basket crashes, the others hold the whole thing up. The most popular and most trusted basket is the S&P 500 Index Fund. It tracks the 500 biggest companies in America, Apple, Microsoft, Amazon, Google, and 496 more. Historically, this fund has returned around 10% per year on average. Not every year, but on average over time. With $100, you can buy into it easily. 2 popular tickers to know are VOO on Vanguard and SPY on most other platforms. That's it. Simple, powerful, and proven over decades. Now here's the step that most people completely ignore, and it's honestly the most important one. Leave it alone. The biggest mistake new investors make is checking their account every single day and panicking when the number goes down. And it will go down sometimes. That's completely normal. The market goes up, it goes down, and then it goes up again. That's just how it works. In 2008, the market dropped by nearly 50%. People panicked and sold everything, but the ones who stayed calm and kept their money in, by 2013, they had fully recovered and gone even higher. The people who lost money permanently were the ones who sold during the panic. So you buy, you hold, and you do not panic when things get bumpy. Here's where everything starts to snowball. $100 invested once is a great start, but $100 invested every single month is a completely different story. If you invest just $100 a month starting at age 25 and the market returns its historical average of 10% per year, by the time you're 65, you would have over $600,000 to $37,000 from $100 a month. That's the power of consistency and compound interest working together over time. The best way to make this happen is to set up an automatic transfer on payday. Pick an amount, even $50 or $25, and automate it. That way you never have to think about it. You just let time and math do the work for you. So let's bring it all together. Step 1, make sure you're ready. No high interest debt, a small emergency fund, and money you won't need anytime soon. Step 2, open an account. A Roth IRA or a beginner investment app is a great place to start. Step 3, buy an S&P 500 index fund. Look for VOO or SPY. Step 4, don't touch it. Ignore the dips and trust the process. Step 5, make it a habit. Automate monthly contributions, even small ones, and let compound interest do the heavy lifting. That's it. No complexity, no tricks, just a simple, proven system that has helped ordinary people build real wealth over time. You now know more about investing than most adults walking around today. The only question left is, are you actually going to do it? Open the account this week, put in your $100, start the habit. Your future self will look back on this moment and be genuinely glad you did. Your 20s feel like a free pass. You're young, you're earning your first real money, and retirement feels like something that happens to other people, much older people, people who aren't you. So you spend. You swipe the card, you tell yourself you'll figure it out later. But here's the problem, later always comes. And when it does, it brings consequences you didn't see coming. The truth is, the money decisions you make in your 20s don't just affect your 20s. They follow you. They compound. They show up in your 30s as stress, debt, missed opportunities, and a bank account that should be further along than it is. So in this video, we're going to walk through the 7 biggest money mistakes people make in their 20s so you can avoid them. Or if you're already making them, stop right now before the damage gets worse. Mistake number 1, living like you earn more than you do. This is the mistake that gets almost everyone. You land your first real job, you see that paycheck hit your account, and suddenly you feel rich. So you upgrade your apartment, you lease a nicer car, you eat out 4 nights a week, you buy the clothes, the gadgets, the experiences, and it all feels completely justified because you're working hard and you deserve it. But here's what's actually happening. You are building a lifestyle that costs more than you earn. And once that lifestyle is built, it is incredibly hard to scale back. Psychologists call it lifestyle inflation. The more you earn, the more you spend, and your savings never actually grow. The fix is simple but uncomfortable. Every time your income goes up, your savings should go up first. Before you upgrade anything, increase what you're putting away. Live like you earn slightly less than you do and invest the difference. That gap between what you earn and what you spend is where wealth is built. Mistake number 2, ignoring your credit score. In your 20s, your credit score feels invisible. You can't see it hurting you day to day, so most people just ignore it. But your credit score is working in the background, whether you pay attention to it or not. And a bad credit score will cost you real money later. When you go to rent an apartment in your 30s, they check it. When you apply for a car loan, they check it. When you want to buy a house and get a mortgage, they really check it. A poor credit score can mean you pay tens of thousands of dollars more in interest over the life of a mortgage compared to someone with a great score. Tens of thousands. The good news is building good credit in your 20s is not complicated. Pay your bills on time, every time. Keep your credit card balances low. Don't open 10 new cards at once. Those 3 habits alone will build a credit score that saves you a fortune in your 30s and beyond. Mistake number 3, not investing because you think you'll start later. This is probably the most expensive mistake on this list, and it's the one that feels the most harmless in the moment. You tell yourself you'll start investing when you earn more, when the timing is better, when you understand it more, when life settles down. But every single year you wait costs you more than you realize because of something called compound interest. Here's a real number to make this painful. If you invest $200 a month starting at age 25, by age 65, you'd have around $1.1 million, assuming a 10% average annual return. If you wait until 35 to start that same $200 a month, you'd end up with around $380,000. Same amount invested every month, 10 years later. The difference is over $700,000. That is the price of waiting. You don't need a lot of money to start. You just need to start. Open an account, buy an S&P 500 index fund, and let time do the work that nothing else can replicate. Mistake number 4, treating a credit card like free money. Credit cards are one of the most powerful financial tools ever created. They build credit, they offer rewards, they give you purchase protection. But in the wrong hands, they are a trap that is almost impossible to escape. And in your 20s, when money is tight and the card has a $5,000 limit, the temptation is real. You swipe for things you can't afford. You tell yourself you'll pay it off next month. But next month comes and you pay the minimum, and the interest kicks in. Credit card interest rates average around 20 to 25% right now. That means a $1,000 balance that you only make minimum payments on can take years to pay off and cost you hundreds in interest on top of what you originally spent. The rule is simple. Never charge anything to a credit card that you cannot pay off in full at the end of the month. Use it like a debit card with benefits. If you can't pay it off completely, don't swipe it. Mistake number 5, having no emergency fund. Life is unpredictable. Your car breaks down. You lose your job, you have a medical bill you didn't see coming. And when that happens and you have no savings buffer, you have only one option: debt. You put it on the card, you take a personal loan, you borrow from someone. And just like that, one bad month sets you back 6. An emergency fund is not exciting. It does not grow, it just sits there. But that's exactly the point. It is insurance against life going sideways. The general rule is to have 3 to 6 months of living expenses saved in a regular savings account. If that feels overwhelming, start smaller. Save $500 first, then $1,000, then build from there. Having even a small cushion changes everything about how you handle financial stress. It keeps one bad event from becoming a spiral. Mistake number 6, saying yes to everything social. Your 20s are social. Brunches, concerts, vacations, nights out, destination weddings, birthday dinners at restaurants, where the cheapest thing on the menu is $40. And nobody wants to be the person who can't come, who always has an excuse, who is weirdly serious about money while everyone else is living their life. So you say yes every time, and you justify it because memories matter and you're only young once. But here's what those constant yeses are quietly doing. They are draining your financial future one outing at a time. You don't have to become a hermit. You don't have to skip everything, but you do need a budget for your social life, just like you have a budget for rent and food. Decide in advance what you can actually afford to spend on fun each month. Say yes to the things that genuinely matter to you and start saying a guilt-free no to the ones that don't. Your real friends will not disappear because you skipped one brunch. Mistake number 7, having no financial plan at all. This is the one that ties all the others together. Most people in their 20s are just winging it. No budget, no savings goal, no investment account, no plan, just earning, spending, and hoping it works out somehow. And hoping is not a strategy. You don't need a complicated 40-page financial plan. But you do need to know three things: what is coming in, what is going out, and what is being saved and invested. That's it. Write it down. Look at it once a month. Adjust when something changes. People with even a basic financial plan consistently end up in a better position than people who earn the same amount but have no plan at all. Your 20s are not wasted years. They are the most powerful years you have from a financial standpoint because time is on your side. But time only works for you if you put it to work. Without a plan, you just watch it pass. Here is the hard truth. Nobody is coming to save you. There is no class that teaches this. There is no alert that goes off when you are making a mistake. You just wake up in your 30s wondering where the money went and why everything feels harder than it should. But you're watching this video right now, which means you are already ahead. You know the mistakes, you know what to avoid. And knowing is the first step. The second step is actually doing something about it. Pick one thing from this list and fix it this week. Just one. Cancel the subscription you forgot about. Open the investment account you have been putting off. Set up a $500 emergency fund goal. One move. That is all it takes to start. What if your bank account kept growing even while you were asleep? While you were at the gym, watching Netflix, or sitting at your regular job, money was coming in from somewhere else entirely. That is what passive income actually is. And before you roll your eyes and think this is another one of those videos promising you'll get rich by doing nothing, it's not. Real passive income takes real work up front, but once it is built, it can pay you for months or even years without you having to do much at all. And the best part about everything in this video, you do not need a single dollar to start any of it. No investment, no savings, no startup capital, just time, effort, and consistency. So let's get into it. 5 passive income streams you can build, starting today with absolutely zero money. Number 1, YouTube. Yes, the same platform you are watching right now is one of the most powerful passive income machines ever created. Here's how it works. You create a video once, you upload it once, and then that video sits on YouTube and keeps getting watched, keeps getting ads served on it, and keeps earning you money for months or years after you made it. That is the definition of passive. A video you made 2 years ago can still be earning you money this week. Now the honest part, it takes time to build. YouTube does not start paying you until you hit 1,000 subscribers and 4,000 watch hours. For most people, that takes 6 months to a year of consistent uploading. But once you cross that threshold and get monetized, the income starts stacking, and every new video you upload is another asset working for you. The key is picking a niche you can talk about consistently: finance, health, cooking, tech, self-improvement, and showing up every week. You do not need a camera. You do not need fancy equipment. A smartphone and free editing software is enough to start. The barrier to entry is $0. The only thing it costs is your time. Number 2, digital products. This one is genuinely underrated, and most people have no idea how powerful it is. A digital product is something you create once and sell unlimited times with zero extra effort. No inventory, no shipping, no manufacturing cost. Once it exists, every sale is almost pure profit. Think about what you already know. Are you good at budgeting? Create a budgeting spreadsheet template and sell it. Are you good at graphic design? Create social media templates and sell them. Are you a student who figured out a great study system? Turn it into a PDF guide and sell it. Are you a good writer? Create resume templates, workout plans, meal planners, business proposal templates. The list is endless. Platforms like Gumroad, Etsy, and Payhip let you upload and sell digital products for free. You create the product once, list it, and every time someone finds it and buys it, money hits your account. No extra work from you. People are making thousands of dollars a month selling simple PDF guides and Canva templates they built in a weekend. The startup cost is $0. All it requires is knowledge you probably already have and a few hours to package it properly. Number 3, print on demand. Most people hear the word merchandise and immediately think you need money to buy inventory upfront. You don't. Print on demand completely eliminates that problem. Here is how it works. You design something, a quote, a graphic, an illustration, and you upload it to a platform like Redbubble, Merch by Amazon, or Printful. When a customer orders a product with your design on it, the platform prints it, ships it, and handles all the customer service. You receive a percentage of the sale. You never touch the product. You never hold inventory. You never pack a box. Your only job is to create the designs and upload them. And the designs themselves can be made for free using Canva or other free design tools. Now, the income per sale is not huge. You might make $3 to $7 per item sold. But if you have hundreds of designs across multiple platforms, those small amounts add up into something meaningful. Some creators have thousands of designs sitting on these platforms, earning the money every single month without lifting a finger. The startup cost is zero. The ceiling depends entirely on how many designs you are willing to create. Number 4, affiliate marketing. This one might be the most scalable passive income stream on this entire list. Affiliate marketing means you recommend someone else's product and earn a commission every time someone buys through your link. You do not create the product. You do not handle the customer. You do not deal with returns or support. You just share a link and earn a cut of every sale that comes through it. Companies like Amazon, Airbnb, Skillshare, and thousands of others have free affiliate programs that anyone can join. Here is how you actually make money with it. You create content, a blog post, a YouTube video, a social media page, a newsletter, and inside that content, you include your affiliate links naturally. Someone reads your blog post about the best budgeting apps, clicks your link, signs up for the app, and you earn a commission. Forever. That blog post you wrote 2 years ago is still sending people to that link and still earning you money. The key to affiliate marketing is trust. You need an audience, even a small one, that trusts your recommendations. That means picking products you actually believe in and being upfront that you earn a commission. You can build a simple free blog on platforms like Medium or a free website through Wix or WordPress. You can start a TikTok or Instagram page around a niche. Any platform where you can build an audience and share links works. $0 to start. Just content and consistency. Number 5, licensing your skills or content. This one sounds complicated, but it is actually one of the simplest ideas on this list. If you have a skill, a photo, a piece of music, a piece of writing, or any kind of creative work, you can license it and get paid every time someone uses it. Let's break that down with some real examples. If you enjoy photography, you can upload your photos to platforms like Shutterstock, Adobe Stock, or Getty Images. Every time a business, a blogger, or a designer downloads your photo to use in their project, you earn a royalty. You took the photo once, you uploaded it once, it earns you money indefinitely. If you make music or even just beats on your phone or laptop, you can upload them to platforms like Audio Jungle or Pond5, where filmmakers and content creators pay to license your music for their projects. If you are a writer, you can write articles and license them through content platforms. The common thread in all of these is the same. You create something once, you put it on the right platform, and it generates income every time someone chooses to use it. Your creative work becomes an asset that keeps paying you without any additional effort on your part. Now, here's the most important thing to understand about passive income. None of these are get-rich-quick schemes. Every single one of them requires real work at the start. You have to create the videos, build the product, design the templates, write the content, or take the photos. That upfront work is the price you pay instead of money. But once that work is done and the asset is built, it starts working for you around the clock. While you sleep, while you work your regular job, while you take a vacation. The goal is to build enough of these income streams that they start to meaningfully add to your regular income. And then eventually, if you stay consistent and keep building, they can replace it entirely. That is financial freedom. Not winning the lottery, not a secret hack, just building assets that generate income without requiring your constant time and attention. So pick one, just one from this list. Start it this week. It does not need to be perfect. It does not need to make money right away. It just needs to be started. Because a year from now, you will either wish you had started today or you will be glad that you did. Something happened this week that has never happened before in the entire history of financial markets. A single company raised $75 billion in one day. Its stock jumped 19% on its very first day of trading, and its founder became the world's first trillionaire. SpaceX just went public, and whether you are excited about it, skeptical about it, or just trying to understand what any of this actually means for your money, this video is going to break it all down for you. What happened, how it works, what the risks are, and most importantly, what you should actually do about it. Let's get into it. First, let's talk about what an IPO actually is, because this is where a lot of people get lost. IPO stands for Initial Public Offering. It is the moment when a private company, one that only wealthy insiders and institutions could invest in, before it opens itself up to the public and sells shares on the stock market. Before this week, if you wanted to own a piece of SpaceX, you couldn't. It wasn't available to regular people. Only venture capitalists, private equity funds, and employees could hold shares. The IPO changes that. Now anyone with a brokerage account can buy a piece of SpaceX, which trades on the NASDAQ under the ticker SPCX. Now let's talk about the numbers, because they are genuinely staggering. SpaceX priced its shares at $135 each and sold over 555 million of them, raising $75 billion, the largest amount ever raised in an IPO in history. To put that in perspective, the previous record holder was Saudi Aramco, whose 2019 IPO raised $29.4 billion. SpaceX more than doubled that record in a single day. The stock opened at $150 and closed its first day of trading at just over $160, pushing the total market value of the company to approximately $2.1 trillion. And as for Elon Musk, personally, the IPO made him the first person in human history to reach a net worth exceeding $1 trillion, with Forbes estimating his wealth at approximately $1.1 trillion by the end of trading on June 12th. So what exactly did you buy if you purchased shares on day one? This is where it gets interesting, because SpaceX today is not just a rocket company. It is three very different businesses operating under one roof. The first and most important business is Starlink, the satellite internet division. Starlink generated roughly $11.4 billion in revenue in 2025, making up 61% of SpaceX's total revenue and the only segment currently generating operating profits. Starlink works by launching thousands of small satellites into low Earth orbit and beaming high-speed internet down to subscribers anywhere on the planet, including places where traditional internet never reached. It currently serves millions of subscribers worldwide and is growing fast. The second business is the launch division, the rockets. SpaceX carries satellites, cargo, and astronauts to space for NASA, the Department of Defense, and private companies. Key contracts include a $2.9 billion NASA Artemis human landing system, contract and commercial crew program missions at approximately $133 million per Dragon flight. This business has made SpaceX the dominant force in the space industry, holding enormous market share of U.S. government space contracts. The third business is the newest and most speculative. Earlier this year, SpaceX acquired Elon Musk's AI startup XAY and folded it into the company's AI division. Through this acquisition, SpaceX is now positioning itself to develop data centers in space, what it calls orbital compute infrastructure, potentially launching the first facilities by 2028. This is the moonshot bet that has some analysts extremely excited and others extremely nervous. Now, here is the part of the video where we need to be honest, because a lot of people are going to see a 19% first day pop and think this is free money. It is not. There are real risks here, and you need to understand them before you do anything with your money. The first risk is valuation. At a $1.8 trillion valuation, SpaceX trades at approximately 96 times its 2025 revenue, a multiple that dwarfs even the most richly valued technology companies and implies growth rates that no company in history has actually achieved. That means the stock price is not based on what the company earns today. It is based on what investors believe it could earn in the future. If that future does not arrive on schedule, the stock price could fall significantly. The second risk is profitability. Despite all the revenue, SpaceX reported a net loss of $4.3 billion in just the first quarter of 2026. The accumulated deficit now sits at $41.3 billion, driven largely by the AI division, which posted losses exceeding $6 billion in 2025 alone. The company is burning through cash at a significant rate to fund its ambitions. That is not automatically a death sentence for a growth company. Amazon lost money for years before it became one of the most profitable businesses on earth. But it does mean there is real uncertainty here. The third risk is concentration around one person. Critics have raised concerns about the company's governance profile under Musk, who also runs Tesla and other companies simultaneously. What happens to SpaceX if Musk's attention shifts? What happens if his public controversies affect the brand? These are legitimate questions that investors need to sit with. So what should you actually do? Here is the honest answer. If you are a long-term investor who believes in SpaceX's mission across all three of its businesses, space, satellite, internet, and AI, and you are comfortable holding through significant volatility, buying a small position is not unreasonable. The key word is small. Do not put money into any single stock that you cannot afford to lose. A reasonable approach is to limit any individual stock to no more than 5% of your overall portfolio. If you are a beginner who just started investing, this is not where your first dollars should go. Your first dollars belong in a low-cost S&P 500 index fund, which gives you diversified exposure to hundreds of companies with a proven track record. Build that foundation first. Then, once you have a solid base, you can take a small speculative position in something like SpaceX if it aligns with your goals and risk tolerance. And if you already own an S&P 500 index fund, here's something worth knowing. As SpaceX grows and its market cap increases, it may eventually be added to the S&P 500, which would mean your index fund automatically includes it without you having to do a thing. That is one of the quiet advantages of index investing that most people never think about. The bottom line is this. The SpaceX IPO is genuinely historic. It is the biggest in market history. It has created the world's first trillionaire, and it represents a bet on the future of space, the internet, and artificial intelligence all wrapped into one company. Whether that bet pays off over the next 10 years is something nobody knows for certain. Not the analysts, not the institutions, and not the guy making this video. What we do know is that investing should always be based on your own financial situation, your timeline, and your ability to handle risk, not on hype, not on headlines, and not on a 19% first day pop. Do your research, invest what you can afford, and never let the excitement of a moment override the discipline of a plan. This video is for educational purposes only and is not financial advice. There is a number that nobody really talks about. It is not $1 million. It is not even close to $1 million. It is $10,000. And if you have never had $10,000 sitting in your account before, what I'm about to tell you is going to sound strange. Because saving $10,000 does not just change your bank balance, it changes your entire relationship with money. It changes how you think. It changes how you sleep at night. It changes the decisions you make, the risks you can take, and the opportunities you can actually say yes to. Something quietly shifts when you cross that number. And in this video, I'm going to tell you exactly what that shift feels like, why it happens, and how to get there if you are not there yet. The first thing that changes is that fear starts to lose its grip on you. Most people walking around right now are one bad month away from a real crisis. The car breaks down and they have to put it on a credit card. They lose their job and they are panicking within 2 weeks. A medical bill shows up and it derails everything. When you have nothing saved, life feels fragile. Every unexpected expense is an emergency. Every piece of bad news carries financial weight. You are always one thing going wrong away from a problem you cannot solve. But when you have $10,000 saved, that changes completely. Not because $10,000 solves every problem, it doesn't, but because it gives you a buffer between you and disaster. Suddenly, a $1,000 car repair is annoying, not catastrophic. A slow month at work is uncomfortable, not terrifying. That buffer is not just financial, it is psychological. And the peace of mind that comes with it is worth more than the number itself. The second thing that changes is that you stop making desperate decisions. This one is huge and most people never connect the dots on it. When you have no money saved, you make decisions from a place of scarcity. You take the first job offer because you need the income now. You stay in a bad situation because you cannot afford to leave. You accept terms that are not in your favor because you have no leverage. Financial desperation forces your hand in ways that cost you enormously over time. Think about how many people stay in jobs they hate for years because they have no cushion to take a risk. Think about how many people accept a lowball salary offer because they need the paycheck too badly to negotiate. Think about how many people stay in apartments, relationships, or cities that are not right for them simply because they cannot afford the disruption of change. $10,000 does not make you rich, but it makes you free enough to say no. And the ability to say no is one of the most financially powerful things a person can have. The third thing that changes is that money starts to make money. Before $10,000, most people are in survival mode. They are paying off debt, covering bills, living paycheck to paycheck, with nothing left over to put to work. But $10,000 is the point where things start to shift. You now have enough to open an investment account and actually feel it growing. You have enough to put into a high yield savings account and earn meaningful interest. You have enough to start building positions in index funds that compound over time. Here's a simple example. $10,000 invested in an S&P 500 index fund with an average annual return of 10% becomes roughly $17,000 in 5 years without you adding another single dollar. In 10 years, it becomes $26,000. In 20 years, it becomes $67,000. In 30 years, it becomes $174,000. From one single $10,000 deposit that you never touched again. That is compound interest doing what it does. And it can only start working for you once you have something to put in. The first $10,000 is the seed. Everything after that is a tree growing. The fourth thing that changes is that your relationship with work transforms. When you have nothing saved, your job owns you. You cannot afford to lose it. You cannot afford to upset the wrong person. You cannot afford to speak up, push back, or walk away from anything. You are financially dependent on that paycheck and everyone around you can feel it, even if they never say it out loud. But when you have $10,000 saved, your entire posture changes. You know that if things go sideways, you have a runway. You have time. You could leave a toxic job and survive for several months while you find something better. You could negotiate your salary with actual confidence because you are not negotiating from desperation. You could take a calculated risk on a side project or a career change because you have something to fall back on. $10,000 does not make you financially independent, but it makes you financially brave. And that bravery tends to lead to better opportunities, better income, and better decisions across the board. The fifth thing that changes is that your identity shifts. This one is subtle, but it might be the most important thing on this list. When you save $10,000 for the first time, you stop seeing yourself as someone who is bad with money. You stop telling yourself the story that you just cannot save, that it is impossible given your income, that other people have advantages you do not, because you did it. You have the proof sitting right there in your account. And that proof rewrites the story you tell yourself about what you are capable of. Identity is powerful. People who see themselves as savers make different daily decisions than people who see themselves as spenders. People who believe they can build wealth behave differently than people who believe wealth is for other people. Crossing $10,000 is often the moment where the identity flips. And once it flips, it tends to stay flipped. The people who save their first $10,000 almost always go on to save $20,000, and then $50,000, and then more. Not because they suddenly earn more, but because something in their mindset permanently changed. Now let's talk about how to actually get there, because knowing what $10,000 feels like does not help you if you do not know how to reach it. The path is simple, though not always easy. The first step is to find out exactly where your money goes every month. Most people have no idea. They earn, they spend, the money disappears. Open your bank app right now and look at last month's transactions. Categorize them, add them up. You will almost certainly find spending that surprises you, subscriptions you forgot about, food spending that crept up, impulse purchases that felt small individually but added up to something significant. You cannot plug a leak you cannot see. The second step is to set a monthly savings target and treat it like a bill. Not a goal, a bill. Something that gets paid first before anything else. If you earn $3,000 a month and you save $500 automatically on payday, you will adjust your lifestyle around $2,500. It feels tight for a month or two and then it becomes normal. The savings build quietly in the background without you having to make a new decision every month. The third step is to put that savings somewhere it cannot easily be touched. A separate account, a high yield savings account at a different bank, somewhere where you cannot see it sitting in your regular balance tempting you. Out of sight genuinely does mean out of mind when it comes to savings. The fourth step is to find one way to accelerate it. Pick up one extra shift, sell something you are not using, take one freelance project, cut one expense you will not miss. Even an extra $100 or $200 a month can shave months off the time it takes you to reach $10,000. The goal is to get there faster, because the faster you get there, the faster everything changes. Here's the thing that nobody tells you about money. The first $10,000 is the hardest, not because the math is the hardest, but because you have never done it before. You have never seen your own account hold that number. You have never felt what that stability feels like. So your brain does not fully believe it is possible. But once you cross it, once you feel it, once you see your own name attached to that account balance, something clicks permanently. The game changes. You change. And the version of you that exists on the other side of $10,000 makes better decisions, takes better opportunities, and builds wealth in ways that the version of you before it simply could not. So if you are not there yet, start today, not tomorrow, not when things settle down. Today, open the account, set up the automatic transfer, make the decision, because the best time to start was a year ago, and the second best time is right now.